All right, Yield Nerds, episode 129, and we are in the home stretch to the election. And there are only a few times of the world where we can say we are 120 years from a presidential election, and we get to see how fixed income fares in this exciting period. And I will share with you what I'm doing about it. Well, we're at 356 subscribers. Thank you. If you're new to the show, please use the playlist, and that organizes the show from a beginner level to where we are today. Most importantly, I do not have any magical powers. Don't trust me. Do your own homework. Well, today I have four topics in my agenda. The first is to look at the market temperature as we go towards that home stretch there and review, a couple of interesting disconnects that are happening in the market and then talk about my trades and next steps. So, how is the market doing? Look at this. Everybody is a genius in the market today. From just the beginning of the year until now, my portfolio has a cumulative return of 6.28%. Hey, not bad at all. And that is state tax free for the most part. And as I start getting excited about it, I realized, oh, if I add the S&P 500, I could have been at 20%. And so maybe I'm doing well, but nowhere close to how I could have been if I just invested in the S&P index. So maybe that is something I should think again about, or maybe not. So let me go on to how I think about it. I do not have the fear of missing out. I'm not going to jump to AI this and AI that just because other people are doing it. But I am increasing my equity allocation slowly. And I went from less than 0.5% to about 0.75% in the last couple of months. And I'm going to keep inching up. And as we near the election, because I have my own thesis on how that is going to go. In terms of time to maturity, I still maintain an extremely heavy allocation on T-bills, but as the T-bills mature, I'm starting to pick off equities. And as we approach the election, I expect to put more and more at that time. And let's talk about the home stretch, as I call it, how I'm thinking about the next 120 days. And before I go any further, I want to make sure you know that I am not a wealth management advisor. I am not giving you tax advice or investment advice. Most importantly, I have no political agenda and I'm not endorsing any product. Well, if I were to look at the market as we come through the home stretch, it appears to me that everybody is assuming the economics of the country is on the precipice of employment problems. All you need to do is look and see that, oh, the unemployment rate is ticking up. People must be getting laid off. The economy is getting weaker and inflation is getting tamed. And both of those put together can only mean one thing. All kinds of rate cuts are coming. And when those rate cuts come, the market is going to go higher. Why wait? We'll just let the market go higher now. That is how, to me, the markets appear to be behaving. And so if the general hysteria is that the only way from here is up, it creates some inflated asset prices. And I'm still a value investor at heart. Well, what are the potential paths and how should I think through it? Here's how I do my thesis. You do you. Without touching politics, one politician says they're going to give tax cuts. Well, if you give tax cuts, you're going to decrease the revenue of the country. If you decrease the revenue of the country, you need to borrow more to balance the books. What does it mean when you borrow more? It means more fixed income products, more treasuries, higher yield. Well, a different party says we may do more infrastructure spending. Well, if you want to spend more, that money needs to come from somewhere, which also means increased borrowing, and increased borrowing means higher yield in the long run. And at the end of the day, if interest rate cuts do happen, which in all likelihood they will to some extent today, that may decrease the debt burden. However, it will devalue the dollar. So where do we go from here? To me, the home stretch from here to the election has a lot of calculus. If the Fed cuts rates in September, then the demand for debt will, think about it, if the Fed cuts rates, what will happen to the demand of debt? It technically should decrease because my premium of owning equities will now become higher because fixed income pays less. The impression is that equities can only go up. more people will chase equities, and therefore demand for debt will decrease. When demand decreases, prices should increase. So instead of buying something that yields 5.5% and it's sold at par, you're going to buy something that yields 5.25%, sold at 97 cents. And at least that is what I think. And short of an earth shattering event, I still plan to have a very healthy fixed income investment. Now, it is not going to be 99.25%. I will be entering equities, but with a lot more thought, and I'm going to share what that is with you. Before I did that, I want to review a very interesting disconnect with you and, walk through this with me as I enter the home stretch. And I don't know, this baseball player seems to be not following the rules. So here is TK Tankers also not following the rules. The last month for TK Tankers has been awful. Their share price is at an all-time low. It has dropped by 8%. ASC, Ardmore Shipping has dropped by 11%. You ask why? The answer that is given is inflation is decreasing. Inflation drives spot prices of tankers, and therefore these companies will not make as much money. And you go, that's interesting. So what you're telling me is that with decreasing inflation, the spot price of moving a barrel of oil in a tanker is decreasing. Point noted. Let me quickly verify that. And I'm about to show you statistics from Fernsley, and you can check them up at fernpulse.com. I do not have any financial relationship with them. This is publicly available data. You may remember TK Tankers has Aframax and Suezmax tankers. The price, the spot price of transporting crude has not changed much, if at all. And so it is my humble opinion that we are going to see that TK Tankers and Ardmore will easily meet their financials. And that's at least my opinion, and I'm not qualified to project stock, but I'm just sharing what I see in the spot price. And so I'm holding on to TK Tankers and Ardmore. So what are the trades that I made? Let me explain a couple of things first. I always start with things that you cannot live without. Well, you can't live without food, and I love my eggs. You need a home, and as interest rates drop, home builders' stock prices will generally increase. You can't live without healthcare. That's a defensive stock. And you need the military, especially in a world like today. And you, I, and everybody else are addicted to our gadgets, so we need semiconductor chips. So with that simple thesis, here is what I ended up doing. This is one of my newer buys, RCAT. And I discussed RCAT a couple of episodes ago. I keep buying more and more of them. I did start Southern Company, which it makes copper. Copper is used in the defense and military industry as much as it is used in electrification. So it's used in both sides of the aisle, if you will, in Washington. So Southern Company seemed like a good buy to me. Tenet Healthcare is a healthcare stock. Once again, aligns with my thesis of things you cannot live without. I did sell Huntington Ingalls, but I kept CW, Curtiss-Wright. And my new one that I picked up a few days ago before the announcement from Powell, the new one that I picked up was Pulte. Pulte has very low debt and very good cash flow. They're a home builder. And another healthcare stock that I picked up is Intuitive Surgical. They are a surgical robot company. They are a growth stock. Fundamentals do not work for them. Their PE ratio is something like 65 or something obnoxious like that. But there are a lot of macroeconomic and microeconomic things that are aligning up towards them. And so as I keep picking up these same themes again and again, healthcare, military, and so on, let me review what that has done to my loss and gain. My portfolio now boasts a 50% pickup on Red Cat, and that is now my top gainer. Pulte, I bought it just before the announcement from Chairman Powell, and Calmaine is always my loyalist. The two that I want to point out, TK Tankers used to be 20% up. They have come crashing down to barely 6% up, which I am going to hold because I believe in them. Ardmore Shipping, I kept buying them more and more as the prices dropped, and I'm now down 13% on Ardmore, but I still think they're going to do just fine. And so here is where I am. You do you, and we'll catch up in a week. Thank you.